if you put on the Austrian economic hat and you look, what is money? Well, gold is money, everything else is credit, according to JP Morgan 100 years ago. Bitcoin is money, everything else is credit, according to Michael Saylor. You have no money, you want to make billions of dollars, and you've got like 3 people and you started a company. If you want to make money, then the smartest idea is to create a form of digital money or a form of digital yield or digital income based on digital credit, right? And I think that's the next interesting topic. And there are 10,000 opportunities, each one of them $1 billion opportunity to create a digital product, a new digital asset, digital fund.
One of Saylor's first observations is that Bitcoin remains an extremely volatile asset. He points out that during certain periods, Bitcoin experienced drawdowns of more than 50%. Even though the long-term trend remains positive, many investors simply cannot endure such dramatic swings. Imagine a family saving for college tuition. Imagine a corporation managing cash reserves. Imagine a pension fund responsible for retirees' income. Even if they believe Bitcoin will appreciate over time, a 50% decline could create serious financial stress. This creates a fundamental challenge. Bitcoin may be the best performing asset over the long term, but many institutions cannot place all their capital into an asset that can lose half its value in a matter of months. According to Saylor, this is precisely why digital credit products are becoming important.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yeah, so, I think, clearly, October 6th, Bitcoin's 125,000 a coin right now. Everybody knows it's like half of that, so we got a 51% drawdown. In that same time frame, to your point, total return on Stretch is plus 4%. It's like positive. Total return on SATA is positive. So people wonder, why do you need digital credit? Well, can you actually invest your family's capital or your corporation's capital and live through a 50% drawdown in the underlying asset and not lose your principal? You need credit. If you look at the stats, right, so Bitcoin falls 50%, the credit holds par or maybe generates somewhat of a positive return. The equity is, my equity is off 75%, so it's like amplified. The other period that I've looked at is May 14th, right? On May 14th, the markets just fell off a cliff. Bitcoin was 82,000 on May 14th, and now, it's fallen 21,000. So Bitcoin falls about 25%. Our equity falls about 40%. The credit's off 3%. It'll be a total return of 2% or something like that. So what we've done, I think, with digital credit is, I think we've shown we can successfully strip 90% of the vol. Maybe, we're all shooting for 95% of the vol to be stripped off, but let's just say 90% of the vol approximately is stripped off. Bitcoin, it was 40 vol for the last 12 months, and then it actually tailed down to 30 vol on a rolling 30-day basis, and then it was 28, and then we thought, this is okay, too good to be true, and then it spiked up, and now it's 40 vol on a 30-day basis and 40 vol on a trailing 1-year basis. So Bitcoin has proven that it's volatile capital and it's digital capital. I think the story on Bitcoin is Bitcoin dominance keeps growing. If you chart Bitcoin, crypto dominance as a percentage of market cap of all the crypto assets, taking out the stable coins, like throw out Tether and Circle, Bitcoin hit a low of about 41% in the height of the FTX era, like 2021. And then Bitcoin has been grinding up from 40%, and now it's like 68%, 69%-ish. So Bitcoin dominance is now, it's getting close to 70% of all the market cap in the entire crypto market. And confidence in Ethereum has collapsed, if you're paying attention. what you see in the rest of the crypto market is there's a competition between Ethereum, Solana, BNB. For the long time, SWI was the next Solana, and then that collapsed, and now there's Hyperliquid, and then there's competition at the layer 2s with Arbitrum and Base, and all of those things have stripped the monetary premium out of all those crypto tokens. And I think that even the people that believe in the tokens realize that they're not money. They're not going to have a monetary premium. They're going to live or die based on utility, and they're all in a difficult competition. So I think the last 12 months have been really good for the position of Bitcoin as the dominant digital monetary network. They've established Bitcoin as digital capital. I think we've proven digital credit is an idea that works. And at this point, the market loses its mind, and at the end of in the bottom of a bear market, and so there's a lot of sound and fury. But if you look beyond that, and you're here at Bitcoin for Corporations, you're a corporation. So I tell you, like, you want to make billions you want to save money, then you buy digital capital or you buy digital credit. That's how you save money. If you want to invest money, then you invest in a combination of digital capital, digital equity, digital credit, or you lever it to create digital yield, or you do something like that. You're an investor. If you want to make money, you have no money, you want to make billions of dollars, and you've got like 3 people and you started a company. If you want to make money, then the smartest idea is to create a form of digital money or a form of digital yield or digital income based on digital credit, right? And I think that's the next interesting topic. And there are 10,000 opportunities, each one of them $1 billion opportunity to create a digital product, or a new digital asset, digital fund, or a digital service that's all based upon emerging market opportunities. And although digital credit is not the only source of energy and opportunity, it's certainly the most obvious and the most scalable one in a hurry right now. If you put on the Austrian economic hat and you look, what is money? Well, gold is money, everything else is credit, according to JP Morgan 100 years ago. Bitcoin is money, everything else is credit, according to Michael Saylor 100 weeks ago. That is true, right? Everything else is, everything else has counterparty risk, and Bitcoin is the form of capital which doesn't have that. So that's the Austrian school of thought, or the Bitcoin standard, and that's how you would use money. But if you go to the fiat school of thought and the Keynesian standard, the way they think of money is it's something that has zero volatility to a fiat currency. So if you look at the $7 trillion of money, or the trillions of dollars in a money market fund, it has to be zero vol generating yield pegged to a fiat currency, whether it's euros or dollars. So when we describe, Bitcoin is a lot of things to a lot of people, I get it. When we describe a stack, a digital asset stack with digital capital, that is a fiat term. We're basically saying digital capital is competitive with metallic capital, real estate capital, equity capital, and credit capital. Digital capital is a fiat term. Bitcoin is much more than that, right? When we say digital credit, that's a fiat term. It's digital credit competing with mortgage-backed credit, junk credit, private credit, sovereign credit, investment, corporate credit, et cetera, et cetera. When we use the word digital money, it's a fiat term. It means zero vol digital currency with zero vol backed by Bitcoin that pays a yield. So why would we call it digital money? Well, because 99.9% of all the capital in the world is in the fiat, is on a fiat standard. There's 1 trillion in Bitcoin and there's 1,000 trillion elsewhere. And so there might be a few gold bugs that would agree with me that gold is money and Bitcoin is money and everything else is credit, and they would say money markets are not money. Maybe a few, but for the most part, everybody with the money and with the capital in the world that we need to attract and bridge into Bitcoin, They think money is a zero vol USD or Euro or JPY denominated fund or asset that pays some kind of yield.
One of the most fascinating parts of Saylor's discussion comes from his economic philosophy. Drawing inspiration from Austrian economics, he presents a simple framework. Historically, J.P. Morgan famously stated, "Gold is money, everything else is credit." Saylor adapts this idea for the digital age. His version is, Bitcoin is money, everything else is credit. What does he mean? Bitcoin carries no counterparty risk. No government controls it. No company issues it. No bank guarantees it. It simply exists as a decentralized form of digital property. Most other financial assets, by contrast, depend on promises. Bonds depend on borrowers. Stocks depend on corporations. Bank deposits depend on banks. Even stablecoins depend on issuers and reserves. From this perspective, Bitcoin represents the purest form of digital capital. Everything else becomes a layer built on top of that foundation.
And so what we're building, Matt and I and other people that are building on this, whether it's like people like Saturn or Apex, they're building either digital yield or they're building digital money, and we're building digital credit on top of digital capital. And the objective is pretty simple, right? We want 5 or 10% of all the credit in the world. So if the credit's 300 trillion, we want 15 to 30 trillion of it to flow into Bitcoin-backed credit instruments. And then we want 5, 10, 20, 30% of all the money markets in the world to flow into digital money, right? And at the end of the day, the idea of perfect, the conventional view of money is a medium of exchange, a unit account, a store of value. And if you ask, how do you become a medium of exchange? Well, if you go and you crawl the web, you'll find that 99.99999% of all the prices in the world are denominated in fiat currencies. Like that's just the way it is. I didn't make it that way. It just turns out that 99.99999% of all the prices are US dollars or euros or yen. So if you want to create perfect money in the eyes of the people that have the $1,000 trillion, and they're the only ones that matter because they have the money and we need the capital. Their idea is it's pegged to the dollar with zero vol, right? Because that way I can exchange it friction-free without a tax hit in order to convert it into a currency and pay for anything. And it's in dollars, which is the unit of account of every accounting system of every multinational in the world, has been, will be. And it pays you a yield, which is in excess of the monetary debasement rate, which means that if you can get above 7%, then you've got a perfect store of value, medium exchange, unit of account in the eyes of every non-Bitcoin maximalist in the world, and it's their opinion that matters if you're actually trying to sell something to them. And so that, when I say digital money, I mean zero vol pegged to a fiat currency that pays a yield, and it's got to be backed by Bitcoin if you're going to do it in a economically sound, technically sound, ethically sound fashion. I have a big following with regard to Bitcoin believers and Bitcoin fundamentalists, and the like, and somehow a lot of times the misnomers, they somehow think that we're encouraging people not to buy Bitcoin or self-custody when we're selling SATA or selling Stretch. And the truth is, I never met anybody that owned Stretch that actually thought it was a substitute for owning Bitcoin. Just about everybody that I've ever met that bought it in lieu of holding money market or holding a credit instrument or having money invested in S&P ETFs or some other equity. So the people that we're finding are non-Bitcoin holders, or we're attracting pools of capital. If you're a Bitcoiner and you need the money in the next 12 months to pay your kids' tuition, well, only half of your children would have got to school this year, right? The other half would have to stay home because of the 50% drawdown. So there's a lot of people that believe in Bitcoin, but they're not going to put 100% of all their family's capital into it. They're always going to need to hold back some portion. So we're providing really an alternative to JEPI or to PFF or to, you know, your favorite bank's money market fund that pays 2%. And that's the competition right now. All these new products, just like with, let's just take the tokens people get worked over, something like Saturn and Apex. There's nobody that's buying Saturn or Apex that would otherwise have bought Bitcoin and held it in cold storage. These are basically Asian, Chinese, off-the-grid, South American, African crypto investors, and they're buying those yield coins instead of Tether. Like they're either holding, probably they're holding a stable coin, which is 80% backed by currency equivalents, or you're holding 100% backed compliant stable coin, or that pays zero because you're from Turkey, you know, or you're from South Africa, or fill in the blank, every single place. You're either holding that or you're going to buy a yield coin backed by Bitcoin. And so when you think about it, don't think that none of these things compete with the underlying capital asset. All they're doing is expanding the network. The real competition is for the $999 trillion of capital that's either invested in the TradFi economy or right now for the $350 billion of capital. By the way, what do you buy if you want yield in crypto? You buy Solana or Ethereum. Or you buy a Bitcoin-backed token, you know, powered by digital credit. So those tokens are competing with Solana, Ethereum, the other crypto yields, or they're competing with, you know, stable coins that generate yield from trading crypto, like Athena, or they're competing with stable coins that pay no yield. And so when you create these products, you're expanding the market and you're drawing more capital into the base layer, which is good for Bitcoin. And you're also creating an opportunity. Like if you're a Chinese investor, how the heck are you supposed to actually invest your money and get paid, especially if you just don't, if you can't stand the vol? And I think, Matt, I don't know who's been selling Bitcoin longer, but trust me, I have spent 1,000 hours of my life selling Bitcoin to corporations and individuals. And it is a large effort. You know, when we pitched it to Microsoft, did we get like 0.1% of the vote? It was 0.1% of the shareholders voted for it. It's a very challenging effort to convince corporations and most individuals to invest in a 40 vol asset. On the other hand, everybody's interested in something that pays them 2 to 4 times more than the money market if you can strip the vol off it. So we actually think that if you want to grow Bitcoin by a factor of 10 or 100, you're not going to do it by preaching to people or even educating them. Trust me, we've spent more money educating than ever. If we actually spent $100 billion a year educating people on Bitcoin, we wouldn't grow the market as rapidly as we're doing it with digital credit right now. Because at the end of the day, the right product spreads virally, word to mouth. People just tell their mothers, fathers, sisters, uncles, buy the thing. And the world is not ready for 40 vol, 30 or 40 ARR asset for most of that capital. It's not a matter of education. It's just they don't have that much capital that can handle that vol in that pocket and that can buy a commodity.
Another misconception Saylor addresses is the belief that Bitcoin-backed financial products somehow compete with Bitcoin itself. He strongly disagrees. According to him, these products are attracting entirely different pools of capital. Someone purchasing a Bitcoin-backed credit instrument is usually not deciding between that product and self-custodying Bitcoin. More often, they are choosing between a money market fund, corporate bonds, preferred stock, traditional savings products. In other words, these products compete against traditional finance, not against Bitcoin. Their role is to bring new capital into the Bitcoin ecosystem. As more financial products become Bitcoin-backed, more demand ultimately flows toward the underlying asset. That creates a powerful network effect.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.